My name is Enza and I'm here with Pete Maracca. I'm really excited today to talk to you about the MLI CMHC Select program. So Pete, we've been talking to our clients about this program, specifically how you can grow a real estate portfolio and redirect clients from investing in Ontario to something way more compelling and intriguing. Tell us a little bit about yourself and how you came about investing in this.
So real estate, been in real estate in the sales side for 16 years, been in construction for basically my whole life. I'm a licensed builder in Ontario, but investing in real estate has always sparked my interest. It's always been exciting for me. So my first property I bought was a rental property in 16 years ago for like $110,000 in Hamilton. And so always in the real estate investing world. I don't know stocks, I don't do stocks, but I do understand real estate very well. And so kind of as things slowed down in Ontario, always seeking more opportunities. And this kind of came about. It's something that I think is very, very exciting. It's something that is around now, and I don't know how long it'll be around, but it's a great program, something that people aren't fully educated on. A lot of people don't know what MLI Select is, but that's the point of this. Hopefully we'll explain to people and educate them on how great it is and how they can utilize it.
So tell us a little bit, that leads us to our first question. What is MLI Select and how can this make a difference in people's investment portfolios?
So MLI Select is it's a CMHC product, but it taps into the government's demand for more housing. So we have a strong need for more more rental properties, not just in Ontario, in all of Canada. So federally, they're trying to find a way to incentivize people to add more rental properties. And we'll get into the challenges of Ontario later, but specifically the program itself is geared to incentivize us to do this. So how they do it is they offer, and typically if you're to buy a rental property, any rental property, you need to put 20% down. And so that makes it challenging for most people, and especially on an apartment scale, you have to put 20 to 35% down on a commercial property, anything over 5 units. And you also have to have, a big net worth. Your interest payments are going to be about 6 to 7 because that's what commercial lending's at. And you're also going to have a 25, 30-year amortization. So to incentivize more people to get in on this, they've extended the amortization, allowed it to be 50 years, which is huge because that lowers the payments. They've also brought the interest rates down to prime-ish. So we're seeing 3.5, anywhere from 3.25 to 4% on a typical CMHC MLI Select back product. Depending on the size, that varies, but bigger products, you're going to get a much less, they're trying to incentivize more dwellings. So the 5-6 plexes, the interest is a little bit higher, but the bigger products, you're going to see more aggressive interest rates. And the third way is 5% down. And that's a big one because, like I said, $10 million building, if you have to put 25, 30%, you're $2.53 million. But with this program, you're able to get $10 million worth of real estate for $500,000. It's unheard of. And so when you really break it down, you see, why it's so advantageous. It's something that a lot of people don't have $3 million sitting around to buy an apartment building that's going to, cash flow a little bit, break even. It's going to be hard to get that ROI back. It's going to take years. And the traditional model for investors in that multifamily world is their big goal isn't the cash flow, it's the passive appreciation that you get. So, just to quickly explain that to people, your passive appreciation is basically, the building grows in value. Like any building, 20 years ago, if you bought a building versus today, it's worth a lot more. So historically speaking, you're talking 3%-ish annually what real estate goes up. And so, if you buy a $10 million building at 3%, after 10 years, that's 30%. Historically speaking, that's $3 million you made. And so to kind of show the difference And if you were to buy a single family home, at $1 million and rent that property out, after 10 years, you're talking $300,000. So it's still great, but I'd rather see for the exact same amount of deposit, grow on that 10 million versus, $1 million.
It's really a way to scale immediately. And so the government is incentivizing you to basically solve their problem because they have a housing shortage. So the way that they're doing that is by allowing regular people to get into buying a multi-unit property at 5% down versus the traditional 25 to 30%. So I know with a lot of my clients, because I've worked with a lot of investor clients, the goal was always, we were playing real life Monopoly, literally, and the goal was always, how do we get to a multi-unit property? So they would start out, so with a lot of my clients, I started out with a single family home, then maybe we did conversions. Then from having one duplex, maybe they were able to have two duplexes. Maybe they could get into a triplex or a fourplex. But the goal was always, how do we finally get to that place where we could own a commercial property? But for most clients, it was just so out of reach. So that's why this has been really exciting for me, for you, for people who are looking to scale their real estate portfolios. So that's exciting.
Yeah, absolutely. I think that, good point, connecting it to Monopoly, and the goal of the game is to acquire as many buildings as possible. And it really is the power of numbers. And so, I try to explain to people, I had 10 rental properties at one point in Ontario. And, when you look at the math, if you have 50 doors, for example, and rent goes up $100, that's, $60,000 a year of extra income.
Right.
If you look at what rent was 10 years ago versus today,
yes,
it's way, way different. I was renting, 10 years ago, I was renting a house for $1,600. Today, you're $2,600.
Right.
So it's much more than $100.
Right.
So the power really is in numbers. And when you can get to 100 doors and the rent goes up $100, you're starting to see massive gains. Never mind $200, $300, $400 a door more. And so, the goal is definitely the more doors, the better, as you mentioned. And I think that, anybody who is hesitant about this, you got to kind of think like, when you buy a house, when you buy a rental property, the goal isn't how much money am I going to make each month.
Right.
And everybody gets fixated when they're looking at these performas, how much cash flow am I making? And even though these are cash flow positive, which is great, the real goal is what we talked about prior, the passive appreciation.
Right.
The goal is, 20, 30, 40 years from now, either you're making a ton of cash flow at that point, and the passive appreciation has, in 10 years we said is $3 million on 10 million.
Right.
And it compounds. So, 10 years later, it's not just 30% on the 10, it's on the 1.3 or 10.13 million.
Right.
And so this continues to increase as you move forward. So at any point you can refinance and go redeploy that to buy another building, and another building, and another building.
Right.
And that's kind of what we were talking about in our webinar we did last time, which I coined the Bieber method.
Yeah.
Buy, build, rent, refinance, repeat. And so we have a lot of people we know in the industry that are very investment savvy, who have taken advantage of this program and scaled the portfolio very, very quickly.
Right.
There's people that started, I know 5-6 years ago, who started with this program, bought a 70-unit building, are now up to 1,000 doors, none of their own money in right now. They refinanced, took their money out, bought another one.
Right.
So they have none of their own capital in these buildings, making $1 million a year cash flow.
And what's really amazing about these buildings is you get into efficiencies, because now they truly are passive, they truly are hands-off. Someone else, a property management, you're buying a business here, someone else is managing the building for you. So you're not worried about your own rental property and tenants calling you. And so people just get tired of that headache. This allows you to grow at a much more efficient and scalable way. So Pete, I know you recently went to Edmonton, you've worked with a couple of developers. We've been actively promoting this and selling some of these projects to our clients already. What type of inventory is available there with these different developers that you're working with?
So we have a vast variety of developments. Anything from 6 plexes up until 250 units. And so, the process needs to be kind of first educate your clients on what MLI Select is, what the program is, and then why Alberta, and we covered that. The next step would be, location and performance, project specific.
Right.
So you always want to try to make sure you're in a very good location. And so some of the ones that we've sold are in that Strathcona area of Edmonton.
Yes.
And you're talking, right beside the University of Alberta, right beside one of the major hospitals in Alberta, and the entertainment district. And so that is a very good project that we have had great success with, that we're going to continue on. But there's a lot of other areas that are good, and even like rougher areas, there's still potential and opportunity there.
Right.
You just need to understand the numbers and make sure it makes sense.
Right.
And so process-wise, it's like educate yourself on what MLI Select is. Then understand why do we want to deploy our money into Alberta, and then after that, let's really crunch down on numbers, on performance, on projects, on where and why and how.
Because this is actually more accessible for people than most people think. So even with those 23 units that we were promoting, I mean, literally people would get in at less than what a duplex would cost to buy in Ontario. But the scale of opportunity was so much larger. So maybe with the 8-plex, like what is the type of investment there? Because
yeah, so I think we'll quickly touch on the 23, like you said, and I'll explain the 8. So
yeah.
A 23-plex, I think we're at like 5.7 million-ish. There's about 290K deposit. If you go buy $1 million property here, that's a duplex or a triplex, you're going to spend 20 to 30% down, which is about $300,000.
Right.
And you're going to be cash flow neutral and maybe even in the negative, depending on the situation. And so, triplex, you'll probably be like good. Duplex, you'll be a little bit underwater. And still it's beneficial because, long term, as we talked about, passive appreciation. But instead of buying a duplex, for the exact same deposit, we can get you 23 units.
Right.
Brand new build, hands off, has massive passive appreciation potential, but also has the rent appreciation potential. So, 10 years from now at $200 a door more, talking massive money. Right. And so, you're absolutely right. You're way better off from buying a duplex, a condo, whatever as a rental investment. Buy an MLI Select product. Right. Right. And so the 8-plex is extremely affordable for people. Right. You can get in at $2.4, $2.6 million on a 6 to 8-plex, and your deposit's $130,000. Right. So much less than even buying a duplex here.
Of course.
And these are because of the 50-year amortization, because of the prime interest rates. You're still in a cash flow positive state, right? Which is huge.
And also, like, maybe for some people they might think, oh my God, this sounds like it's so big, but talk about how REITs are looking to buy these up all the time. There are exit strategies. So because I worked with so many investors, it was always, when you get a client into a product, how can you get them out if they needed to get out? So talk a little bit about the REITs.
Yeah, and I think the beauty of this is there's tons of options. The big thing to me is always, scale, grow. Right. You always want to go long term. Right. Right. The more you can acquire, as we talked about the Canadian monopoly, that's the best. How do we get as many of these properties as possible, as long as possible? That's going to be the most amount of gain. You hear tons of stories of people that say, hey, I wish I didn't sell that property 10 years ago. It would be worth this today. It would be worth this today. Yes. And the beauty, even though listen, nothing is easy in life. Yes. But real estate renting, that this process of building an empire, it's quite passive. And so there's not many things you can do where it might cost you $400, $500, $1,000 a month extra. Not very much time. Yes. But in 20, 30 years, you have millions and millions of dollars that you have access to. And so, it's very, very rare. There's not many other opportunities like that. The passive growth of real estate is key to me. So I don't love the idea of selling it,
Right.
but REITs are willing to gobble these up. And so REITs work on a much lower percentage, but they're not venture capitalists. They don't look to buy something that's not built yet. They want to see stabilized numbers and leases that are, so you got to show them 2 years history typically, but they love to gobble these things up.
Right.
So you can sell these to people, quite easily after they're leased up and stabilized.
So in your opinion, I don't think you need to be a sophisticated investor to get started with one of these. So what's your opinion?
Yeah, no, I fully agree with you. I think that, your cost of entry is quite low. You have, everything is pretty hands-on. When you deal with, someone like yourself, myself, professionals that understand the process, we can really hold people's hands through it. And it's just education.
Right.
It's how do we get to step one? How do we understand step two? And because we have the back end taken care of as well, the property management side of things, it really is a turnkey investment for
Right.
people that they don't need to think about, worry about. It's different when they have to manage it and run it. And when you're buying one or two, it's really hard to hire a property manager,
Right.
because it eats at your numbers quite a bit. But again, economy of scale, when you have 20, 30 units, it's much less of a drain on the overall number.
Right.
Right. And so it makes it much more easy to get a property manager handle all your headaches. So this really is a turnkey investment. You're also buying a brand new building.
Right.
So you don't have endless maintenance issues and endless repair issues off day one. You have years before you're going to start seeing issues. They're going to be desirable because they're brand new. This developer that we deal with, appliances are included, window coverings are included, landscaping's done. So it really is a whole turnkey product. So to me, it's very easy for an investor to jump in.
So there's no hidden costs, because I know with some other projects you have to be a little bit wary of that. So it's perfect for an initial investor if you're looking to get in, if you're looking for something that's truly passive, hands-off approach because someone else manages for you. And also what I've been doing is I've been working with some of my clients if they're just sort of tired of dealing with tenants, or if they've had, because of the interest rates, they've had some years where it's been either cash neutral or cash negative. We've been actually helping them sell their properties here and redeploying that capital there. So it'll fit for both.
Fully agree. I've even talked to people who, even if you have to take a little bit of a hit here because the market's down, you're still better off. You have people here who have a rental property that's worth, let's even call it $800,000, and they have next to no mortgage on it. And I could have sold it for $1 million, or even if they have a $300,000 mortgage on it and they have $500,000 sitting there of equity, and they're like, well, I'll wait until it gets better.
Right.
Well, at the end of the day, you're costing yourself time and money to scale. And when you really crunch it down, you got to look at it this way. You have 500K sitting there of equity, for example, and maybe you're cash flow even or making a little bit of money. But what is the long-term goal of that? If you keep that $800,000 investment for 10 years here, and it grows at 3%, you're talking $250 of growth over 10 years at 3%, so 30% over 10 years.
Right.
You take that $500,000 and you redeploy it in Alberta through our program, that's $10 million worth of real estate.
Yes.
And we already talked about that. That's $3 million of growth over 10 years. So instead of making $250, you're making $3 million. So even though you think you're losing money by selling your asset here,
yes,
you're going from an $800,000 investment to an $8 to $10 million investment. You're going from cash flow neutral, maybe a little bit positive, to $3,000, $4,000, $5,000 a month positive. It's really a game changer. I think everybody needs to understand the program better and understand why people are flocking to Alberta.
And when we were speaking with the developer when he came into town, he literally said this is the opportunity for a regular person to get involved in a very sophisticated, natured investment and make it simple and easy to do. So this has been really informative. I really appreciate your time. So what would be the next step if people are intrigued by this and they want to find out more information?
I think just reach out, right?
Yeah.
Reach out, ask us questions, shoot us a DM, an email, phone call, whatever you need to get a hold of us to understand the program. We're happy to talk about this. It's exciting for us, and it doesn't have to be just one of you. If you can't afford it on an individual scale, this is something 10 of you can put, $20,000 each to,
Right.
and start a portfolio,
Yes.
right? The power of this is it's not about your income. And so a lot of times people are hesitant to buy real estate or unable to because their income level doesn't allow for them to buy anymore. The beauty of this is it's based on your debt service ratio of the building,
Right.
not on your total service debt ratio. And so it allows people to scale up, not affecting their personal buying power.
Right.
And that's the commercial world and the power of that. And so, even if you have some equity in your home and you're thinking, hey, maybe I should do something with it, good to talk to us.
Right.
If you have a few members of your family or a few friends that want to, get into investing in real estate, talk to us.
Yes.
This is, to me, the golden goose opportunity for people to really build a passive portfolio and build some generational wealth for themselves, their family, and future generations.
And take advantage of this program for as long as it lasts, because we know they're government programs, they might not last forever.
Absolutely.
So we're happy to help you. We've been helping some of our clients already get in on this exciting new program. So we're here for you. Reach out and we'll hold your hand every step of the way. You're not in this alone, and we'll demystify this whole process.